In this video, I want to introduce you to the concept of transfer pricing. So a transfer price is the price that's charged by the selling division to the buying division for an intermediate product within the same firm. Okay, so let's say we're talking about a company called ABC Automotive Company, and they have multiple divisions. And let's say that one of their divisions produces batteries. Okay, so they could sell those batteries within the same firm. They could transfer them to the automotive assembly division. Okay, so let's say there's this division that they actually build cars. Okay, so that's their output is cars. And then this division's output is batteries. And so the battery division could actually sell those batteries to an outside entity. There could be some outside firm that purchases the batteries from the battery division, or the battery division could sell the batteries to the automotive division within the same company. Okay, so this is all one company here, and then the battery division is selling the batteries potentially to the automotive division. Now the question is, what is the price? What is the price that is going to be charged by the battery division to the automotive division? So if the automotive division buys a battery, do they pay $60? Do they pay $70? Do they pay $100? What is the price? Now you might say, who cares? You might say, who cares? This is all the same company. Why does it matter the price? Well, the thing is that the battery division, if they are being evaluated based on their profit or loss, and then the automotive division is being evaluated on their profit or loss, each division has an incentive where they want to maximize the division's profit. Okay, so the automotive division wants to show as high a profit as possible to make the corporate management happy. The person running the battery division wants as high as profit as possible. So there's an issue of, okay, well, we need some kind of price. We need some kind of price, and that's called the transfer price. Okay, it's the price charged by, here we've got the selling division is the battery division, and then the automotive division potentially is the buying division, assuming they do buy from the battery division. Okay, because remember, the automotive division could buy a battery from someone other than the battery division, also from outside the firm. Okay, so transfer prices there's really two components here, two really major components. One is for internal decision making. We're talking about cost accounting, managerial accounting. Transfer pricing is used to coordinate the transfers within the firm. So we're trying to figure a price that will lead to the optimal outcome for the company. And it might seem like it's not a big deal, as I mentioned, but the choice of the price could actually lead to some cases where, let's say, for example, you use something full cost, which we'll talk about later. You might have a situation where the divisions don't end up agreeing on a transfer, even though to do so would have been optimal for the firm. So we're trying to find the best transfer pricing strategy for the firm to make sure that we coordinate these transfers in such a way that we maximize the value of the entire company. This division has an incentive. The manager wants to improve their division, make their division look as good as possible. The automotive division wants its division to look as good as possible. But how do we coordinate a transfer that looks the best for the entire company as a whole? Okay, so that's just internal use, but there's this whole other component of transfer pricing that has to do with outside the company, not thinking about internal decision making, but about thinking about reporting to tax authorities. Transfer prices have to be reported to tax authorities because when you've got this intermediate product, and in this case, the intermediate product is a battery, and when I say a battery is an intermediate product, maybe I should explain that more. Obviously, a car is going to use a battery, so the automotive division needs to obtain a battery in order to produce their product. Okay, so when you have this multiple divisions in different countries, and then they're making transfers between the countries with these intermediate products, such as a battery being sold to the automotive division. Imagine if they're in different countries, and then we're trying to figure out the transfer price. Companies have an incentive to manipulate these prices in such a way that they could reduce their tax liability. And tax authorities know this, so there's a lot of fights and disputes regarding transfer pricing with companies. So in terms of what should be the price for tax authorities, every country is different, but generally it's supposed to be based on an arm's length transaction and say, okay, if there was two parties who weren't related, what would be the price that would be charged? What would be the arm's length or price in an arm's length transaction? Figuring that out, that's another issue. Okay. Now, so about 75, 80%, at least 3/4 of companies, they will use the same transfer prices for internal use that they use for tax authorities, that they report to the tax authorities. But not all of them do. And it's when you have different prices for internal use and for tax authorities, it's called decoupling, when you have the different prices. So let's say that, so we just focus on internal use now. There are three main ways that a company can, three main types of transfer prices that could be used. One is, you could say, market-based transfer price. So you're trying to figure out what is the price charged for this battery. You say, well, what would be the market value of this battery? What could this battery be sold to an outside entity for? Okay, and that's similar to the idea of arm's length. You're just basically saying, look, if we didn't sell it to the automotive division and we sold it to somebody else, how much could we get for it? And then that would be the price charged to the automotive division if the company used market-based transfer prices. Cost-based is saying, look, we're going to, whatever price will be, it'll be the variable cost of the battery division, or it'll be the variable cost plus 10%. That's called cost plus. Or it could be full cost, where we say, okay, all the variable costs, all the fixed costs. We'll talk about this more in another video, but the main idea is it's somehow based on the cost to produce the battery. That's used to figure the transfer price. And then also, finally, you could allow the managers to negotiate between them. You could allow the battery division and automotive division to say, listen, there's somebody running each of these divisions, and you could just work it out and negotiate the price between you. And if you can't negotiate the price, then I guess automotive division will have to buy batteries from elsewhere, and the battery division could sell their batteries elsewhere. And we'll talk about all these concepts more in the videos to come.